Hello everyone, I welcome you all to again the next chapter of our futures learning. Now in the previous two chapter we got acquainted with the concept of forwards and the futures. We understood what are the different features of forward contract, what are the different features of futures contract, what are the issues which were faced while trading forwards contract, and how did futures contract go about solving those issues. Now having understood, now we need to understand that why should one actually be trading in futures? Does it even make sense to trade futures contract? Let's try and figure out. So let's start with a simple hypothetical scenario. Say for Reliance Industries, there has been a sudden fall in prices, but this fall in the shares of Reliance Industries has been mainly attributed to the rising farmer protest and other related to factors. Now the market has got a knee-jerk reaction and the market has almost tumbled by 4 to 5%. But as a trader, I'm of the view that there's nothing wrong with the fundamental and overall technical picture for Reliance Industries, and the move has been exaggerated. And I'm of the view that the market should go back up again sooner rather than later. So how do I go about expressing my view? I simply buy one lot of Reliance futures contract for near month expiry. When I say near month expiry, I'm talking about the expiry of the current month, which will happen on the last Thursday of this month. And buying futures contract also limits my risk because I can only hold on to my contract till expiry. Of course, I can roll over my position to next month, but for this current contract, the expiry is for this month only. So which limits my risk because I'll be willing to exit my position before that, and I'm just trying to benefit from the fall in the price of Reliance Industries, buy at a lower price and sell at a quick higher price and make quick gains out of it. So those are some of the benefits of trading via futures contract. And this is how the ticket offer, or this is how the presentation of futures contract looks on the website of National Stock Exchange. If you see on the screen here, it shows stock as futures and the expiry is 28 Jan 2021, and you see for all the different price levels, you see the amount of bids and offers which are in the market right now. This is a simple demo of that. How does it look like? You get to also see the number of contracts which are traded in the market, what are the traded value in the market, what are the number of shares in every lot, which is 250 here. This gives you basic information about the total pricing of the futures contract of each and every share. For our demo, we have used the example of Reliance Industries. Now the next important point is this: if I have a bullish stance on the shares of Reliance Industries, why should I just not go in the cash market and buy the shares of Reliance Industries? Why should I trade futures contract? What is so lucrative about futures contract that I should trade futures contract and not invest in the shares of Reliance Industries and go in the cash market? The simple answer to this is the financial leverage. Now what do you mean leverage? Leverage gives you the power to buy something which is right now out of your hand because the price is too much, but because of leverage you are able to afford it and you can actually get in the market using that. How does that happen? Supposedly you bought the shares in the spot market of Reliance Industries. Then the price of one shares of Reliance Industries 2016, and the total number of shares which you are planning to buy is say 750, and the total value of shares bought will be 2016 into 750, which is 5,04,000 rupees. And if the share price of Reliance goes to say 2100, your view is right and the market goes up, and the total profit which you'll be making here is the exit price minus the entry price into 750 shares, that is 21,000 rupees, or 4.16% on the investment which you made. The investment which you made is 5,04,000, the profit which you have made is 21,000, so which comes out to a 4.16% on the investment made. But if the similar views were expressed via futures market, then the price of one share of Reliance Industries again is 2016. The total number of shares by buying the futures lot is 750, and the total value of shares bought is again 5,04,000. Now, but the margin required to buy one future lot is 1,20,931. This is the financial leverage I was talking about. By putting just 1,20,000 rupees in the market, you are able to buy shares worth 5 lakh rupees in the market. So it gives you a leverage of almost 4x, little more than that only. So if the share price goes up to say 2100, then the profit made again here will be 21,000 rupees. But the return on investment is 17.37%. In case of our spot market, the return was nearly 4%, but here the return is 17%. How do we get that? 21,000 rupees made on the investment of 1,20,931. It gives you a return of 17.3%. So this is a classic example. By investing or expressing a view by futures market, you can make much more return on investment because the amount of invested capital is much lesser. So that is the benefit of trading via futures contract. Now, what are the key differences? In futures market, one can be a part of the bigger game with a limited capital. As in the previous example, we saw that to buy the same number of shares, you have to shed out almost 5 lakh rupees. But in case of futures market, you have to just shed out only 20% of the capital required to buy that many shares. So with limited capital, you can be a part of the bigger game. High return on investment as compared to spot market, simple, because with 5 lakh rupees you generated 21,000 return, but in case of futures market with 1,20,000 rupees you generated a return of 21,000 rupees, which gives you high return on investment made. And shorting is allowed. In case of cash market, although the shorting is allowed, but the position will have to be squared off at the end of the day. But in case of futures contract, you can carry over your short position to next day. Because you've already deposited certain amount of margin in the market, you can carry on to your bearish views for days to come and make higher profit on the investment made. So that is one benefit of using futures contract over cash market. Now, what are the key takeaways from this chapter? The margin gives us the power to deposit small amounts and benefit big exposure to undertake large value transaction. In our example also we saw, with the amount of margin required is only 1,20,000, you could be a part of a game which was much bigger as compared to cash market. Normally the amount of margin charged is only a percentage of the total contract value. In case of Nifty indexes, the margin is only 10 to 12% of the index value, and in case of stock market or in case of shares, it is between 20% to 50% depending on the volatility of the shares. The trades in the spot market cannot be leveraged. You can buy only the number of shares which your capital allows. If you have only 1 lakh rupees, you can buy only shares worth 1 lakh rupee in case of a spot market, which is not the case in case of futures market, because they allowed the function of leverage. And the profits made by buyer is equivalent to loss made by seller, and vice versa. The amount of money which I'll be making is the amount of money which someone else loses, and vice versa. And higher the leverage, higher the risk, but it allows the benefit of making higher profit. The more you leverage, there's a better chance of losing the capital, because if the market moves to the amount of leverage, you lose all the leverage money or the margin money which you put in the market. But it gives you the chance of making higher return investment made. It's a zero-sum game eventually. With limited capital, you can be part of a bigger game, but you also run the risk of losing the capital which you've invested in the market. I hope this chapter gave you a brief on understanding the futures concept and their pricing, and how does trading in future contract is beneficial over the spot market. In the next chapter, I'll be dealing about more concept of futures market. I thank you for your patient hearing. I'll see you in chapters to follow. Thank you so much.